and then we can get started. So how are you guys doing? That's good. That's good. And how are you finding Unit 2? You guys did read Chapter 2 in your textbook. You? You don't have your textbook yet. So what did you do? Did you ask any other students to send you photos? Those who have textbooks. You didn't think further than your nose. I don't know why. I'm used to that. Now, cool. Um, so have you had a counting before? Yeah. All right. So it's no train smash if you haven't read ahead. It's no train smash. It will just make your life slightly more easier. But today, really, we're just delving into, the basics of accounting, the different account types. Okay. So the slides you see here are actually from the development. So like I told you, I don't have slides in Unit 2. Right? And I thought I'd actually use this to introduce the new subject matter. Okay? Right. So in Unit 2, let's get into this. What you guys find Unit 2? That should be better. Okay. In Unit 2, we have the accounting equation. Now, for those of you who have had accounting, this I'm sure looks familiar. All right, but for those of you who haven't, no problem, because you are in grade 10. All right. So the accounting equation is assets is equal to liabilities plus equity. Okay. And as we go through today's lecture, we will actually find out what the hell are assets. Okay. What are liabilities? What is owner's equity or equity? Okay. Right. Now the accounting equation, this thing always has to balance. Okay. If we add up our liabilities and equity, and for some reason that does not equal our assets, then we know that somewhere in our books we've made an error. Either we've left out something, all right, or we have actually overstated something. In other words, added more than we should have. Does it make sense? Okay. One or the two. But this equation must always balance. Okay, it must always balance. Then we know things are right. Right? Now, briefly, it is used in the business to calculate the worth of the business, okay? The accounting equation. It's a true equation that always balances. This is due to the double entry system. So we'll learn more about the double entry system as well, and I don't know if we'll cover that as well. But basically, remember we said that the father of accounting, and who was the father of accounting? Yeah, I'm hearing the right things, but I'm not saying it because, yes, Luca, and I know you also said it, I'm sure you're about to say the same thing. Okay, it's Luca Pacioli, okay, right? And I'm only not sure if I'm pronouncing his surname right, but oh well. As long as we can collect those marks, right? All right, cool. So, where was I now going with it? He created the double entry system, all right? So we'll have a look at that. It's not today, it's something. Okay. Now, assets are things that we own. Okay. But things that we own, that can generate us income. All right. At some point in time in the future. All right. They will use us something of value. And liabilities are things that we own. Okay. Then owner's equity, this is the capital that the owner or the assets that the owners have actually put into the business. Okay. Please let's put our devices on silent devices. Okay. And then obviously assets. So we could use our liabilities, funding that we receive from FNB or Standard Bank, or we could also use our equity. In fact, usually it's a combination of both to fund our assets. Okay, so that is your accounting equation. All right. Now, these are the different account types that you get. You get assets, you get liabilities, you get owner's equity, you get revenue, also known as income, and you get expenses. Every single account that you have in your accounting will fall under one of those five. Okay? Um, one of those five. And we'll play around with some exercises later on. All right? So, as we highlighted, all right, and I'm just going to take you guys through your textbook for this, all right, as we go through this slide, as we go through the different account types. All right, if you go to page 24, and those who don't have page 24, don't worry, I will be mentioning everything that's significant and important. Okay, so on page 24, this is at the top of the page, under definition, what is an asset? An asset is a present economic resource that is controlled by the business as a result of cultivation. You must remember that we don't necessarily need to own assets, right? But we need to be able to control it in order for it to be considered an asset to us. In other words, I could sell Herbalife, for example, on behalf of Herbalife. I don't own the equity, but I can go to someone and say, look, I have this product, it's going for X amount, would you like this person? You can say yes, you obviously pay me, and then I obviously order the stuff and send it to her. Does that make sense? I don't own the actual thing that I'm selling to her, but I have control. I can get it delivered to her as and when we have agreed. Does that make sense? So that's still an asset to me. All right? So you don't always have to own it. Okay? But you must have control. Right? And it must realize value for us at some point. Those are the two things. Now, when it comes to assets, we have two types of assets. Somebody tell me what type of assets do you have? Yes. Current assets, yes, and non-current assets. Thank you, guys. Okay? We have current assets and non-current assets. Now, tell me something. What is the distinguishing factor between a current asset and a non-current asset? So, in the period of 1 year, yes? Okay, all right. So the distinguishing factor between a current asset and a non-current asset is current asset is 1 year or less. You're holding it for 1 year or less. And non-current asset, as we've highlighted, is longer than 12 months, longer than the year. Okay? And then, on page 24, you can actually see examples of non-current assets. We have land and buildings, plant and equipment, plant and machinery, equipment, financial assets. Okay? Motor vehicles. Okay? All right. Now, financial assets, you have to be careful because you need to distinguish. Because in the savings account, the short-term savings account will be a long term. Somebody will tell you. But typically, if it's a fixed account, typically it's a long term. And this one, typically, unless they give you the maximum effective because of the problem. Okay. And anytime you will have, you will think, most of the assets that you will be looking at are typically things that you can hold in time. Yes. Intangible assets are obviously things that you can't know this. Now, what is important is that if you do have intangible assets, they usually long-term assets, okay? Non-current assets. Okay? Sometimes you use long-term assets interchangeably with non-current assets, okay? Or short-term assets instead of saying current assets. Okay? Cool. Right, and then obviously current assets example, we have trading agencies, we have debtors, the people that owe us 60, the people that owe us beyond the payment within the year. Then we have cash in the bank, like you spend that in the petty cash, all right? Money you keep in the office, all right? And then cash flow. this is the money you put in the till, you know, when people buy stuff, you can give them till. That. And then we have input that. Now we'll go with this war in unit 3, and we will see it until the end of our journey with this textbook. But for your purposes, take note, put in NG, circle it, underline it in red. And input that is a current asset. All right? All right. Input that is a current asset. Okay? And trust me, we are consistently going to be testing you on your knowledge of whether input that is a current asset or anything else. I won't throw in typically what we may. Okay, let me just say, sometimes people think it's a current liability, and you'll understand why I'm saying that later. But anyways, let's proceed. So we've dealt with assets. Let's move on now to liabilities. What's the liabilities? Liabilities are debt. I'm on page 26. Liabilities are debt. I'm reading on the definition here. Right? They represent the business's present obligation to transfer economic resources due to past events. All right? We walked into AXA and we said, I want 2 million rand so that I can, you know, build a factory, so that I can produce handbags. All right? That's the past event. We walked into AXA, asked for money. Now, AXA wants me to pay an installment every month. All right? I owe them. That's a debt. Okay? And it's very obvious to see our resources. We take money from our resources. All right? So, just explaining that, giving a practical example to what are the actually. Once again, now with liabilities, we have short-term or current liabilities, and we have non-current liabilities. Somebody tell me what's the difference between a long-term liability and a short-term liability. Anyone? Yeah. Uh-huh. Oh, the beauty. Oh, I thought it was this beauty. No, it's not. Yeah, sorry. It is out. The distinguishing factor is one is for data, and the other is for modern data. So the reason why I'm highlighting that is because I need you guys to understand what is a one-time liability and what is a covenant liability. Likewise, what is a current asset and what is a non-current asset. And if you know that from here, then it just makes our lives easy. So as was highlighted, yes, the distinguishing factor is literally the time period. All right. So, yeah. Then we can now look at examples. All right. And then the examples just make total sense. When we're talking about a mortgage loan, which is typically something you take out on a house, right? And we would pay for longer than a year. All right. So that obviously makes sense as to why it's not time. Bank loans, all right, that mature later than a year. Okay. Then we have current liabilities. That's a bank overdraft. Typically, you know, you're not going to be permitted to have an overdraft for years. Okay? Right? You pay it off and then you can access it again, pay it down, access it again, etc. And we're not going to allow you to have an overdraft for, you know, an outstanding, should I say, overdraft for years. Okay? Then creditors. All right? These are people that have obviously we've borrowed from. Sorry. These are people that we borrowed from. Okay? Then we have SARS. So, you know, we don't pay our taxes immediately. We pay them at the end of the financial year or in February. When does the tax year end? September. September at least for individual. Yes, I think it's dependent also on your financial year. Yes. You always choose your financial year though. So you could choose June, you could choose August, you could actually choose December, you could actually choose, but most businesses choose February, right? End of February, then date of month. Yes, all right. So we dealt with liabilities.
Now, in your textbooks, they go on to define what a supplier is. Supplier is just someone who's offering us services, all right, or products that we need in order to run our business. Okay, simple. Right. Flip the page. Okay. There you can see on page 29, and I'm just going to do this. Let's do this. Let's get into unit 2. And I just want a page that we can mess around with. I'm not even going to label it. Okay. And this is basically what I want to show you guys. So we said the accounting equation is assets is equals to what? Okay. All right, all right. Liabilities plus what? Owner's equity. Okay. Now, guys, this formula, like any other formula, can be played around with. All right. It's not static. It doesn't have to stay in the same. So if you wanted to find out what our liabilities are equal to, what would we do? Assets minus owner's equity. Okay. And we test your. So can you see here? He's obviously mastered the formula. Now he's applying it. Because we could ask the question, calculate your liabilities. And we'll give you assets and we'll give you owner's equity. Right? We might not, well, we wouldn't give you the formula because it's too easy. If we give you the formula, then you'll know exactly how to. All right? So that's an example of application taking place. All right? Then what about if we want to calculate owner's equity? It would be assets minus liabilities, and we'd have our owner's equity. Okay? All right. So I just thought I'd mention that because on page 29 there in your textbook, they're obviously looking at the accounting equation. Then the double entry rule, I think we'll deal with that later. Let's leave that. Now we have proprietary accounts. Proprietary accounts. Did we speak about proprietary accounts? Whenever we're using proprietary accounts, who are we conducting it? Somebody tell me. And you reading the text, so I don't mind. The owners of the company. Proprietary accounts are only for the owners of the company. And which two proprietary accounts do we have? What? Capital is what? So it's capital and drawing. Now, we're now speaking to owner's equity. Capital and drawing always affect owner's equity. Okay? How much money we have in the business. When I take something out of the business, I'm reducing my capital, I'm reducing my equity in the business. Does that make sense? When I put money or put in an asset, a laptop, a car, donate a building to my business, whatever it may be, that is adding to my capital. In other words, increasing my owner's equity. Okay? Right. Let's proceed then. So proprietary accounts, remember, only pertaining to the owner of or owners of the business. Okay? And these obviously affect owner's equity. All right. Let's proceed. Okay. Right. On page 37 in your textbooks, they ask what is income. And as I said earlier, revenue is the same as income. Okay? Revenue is the same as income. And somebody tell me what is income? What is revenue? What is that? Yeah? money that the business is making is the turnover. All right? But yes, it's the money that the business is making by way of making a sale, by way of maybe rendering services, whatever it is your business does. All right? It's that money that you manage to generate. Okay? That's all that it is. Okay, here I see they've gotten a bit academic on you guys with the definition of it. But in a nutshell, that is what it is. All right? What are expenses? What are expenses? What are expenses? Yes. Yeah. So everybody else? So I agree with you guys. But there's only one issue that I have. One issue. You mentioned the stock. 100%. Stock is your current asset. Now, I love that we are here. Now, because the question then is, what distinguishes an expense from an asset? Because whenever we get an asset, and I see your hand, and I'll put this up. Whenever we get an asset, right, we have to spend money. Money leaves the business, all right? And that's typically what happens with all our expenses. It's money leaving us, all right? So what is the distinguishing factor between an asset and an expense? Mm-hmm. But expenses are different from liability. Yes. Mm-hmm. Stationary, packaging material. 100%. So that's the distinguishing factor here between an expense and an asset. When we spend money on an expense, we're not anticipating that this thing that we spend money on is going to generate money for us. Does that make sense? Remember that asset, the key definition there is something that is coming from it, is something that is going to generate money for us at some point in the future. For instance, when we think of trading inventory, we're planning to sell that tomorrow, as soon as it hits our shelf. Okay? Let me just say that, as soon as it hits our shelf. When we purchase equipment, when we buy a printer is also an asset. But that's not going to actually yield us immediate money. When we print our invoices by way of doing one or two things in the office and using the printer, it enables us to obviously produce our final product. Right? Same as any other machinery. It enables us to produce our final product. That then gives us money. So can you see? Different assets play different roles, but at the end they do give us some sort of monetary value. Okay. So that's the distinction. Now, I love where we were between. We are between liability. There's a very close relationship between expenses and liability. But the distinction factor between expense and liability, the expense is right now. Alright, so if you look at things of expense, so this is expense as a result of having taken out a loan. A loan is a liability. Okay? But you will get the interest, interest expense, or interest rate as an expense. Calculate the amount that you will use. So there's a very close relationship, but there is a difference between a liability and an expense. And guys, the reason why I'm saying primary is because it's so important. If you cannot categorize which account belongs where, you said it, I didn't. Yes. Sorry, say it again. Mm-hmm. That's a very good question. Because the truth of the matter is, you render services to me today. I'm only going to say this right now, and explain it. Right now, when we say like this, when we make payments, so income statement or your profit and loss statement, when we're actually paying the money, all right, that's when it becomes an expense. But during the course of the month, it's actually reported like an expense. And you will see that in unit 8, when we cover salary and how we actually report it. So if you will be reporting that at the beginning of the month, all right? So obviously, it's now a liability. So it's a consequence. Remember, we only account for consequence when we have sold this stuff. We never account for it prior to that. So we find that we have purchased, let's say, 5,000 worth of business, but we only sold 2,000. We only calculate the cost of sales on that 2,000 because that is what the sales to the amount. Does it make sense? So, very good question. I hope I answered it. So we've dealt with everything now in terms of what are the different types of accounts. All right, and we were just speaking to cost of sales, and that's what we have on page 38. Cost of sales is literally the cost that is incurred on the inventory that has just been sold. Don't overthink it, it is literally that. Okay? We only account for that cost when we have sold that inventory, those products. Okay? Right. Okay. Let's go on. Right, then we have the definition of debt. Oh, sorry, debit. The definition of debit on page 43. Definition of debit on page 43. For those who have had accounting before, what is debit? Okay. Those of you who have your books open, you can also. Yeah, okay. What is debit? Yes? Uh-huh. What is a T account? What is that thing you're talking about? Let me change colors. Okay, it doesn't want me to change colors. So this is a T account. We did speak about this, I think. So this is what he's talking about, debit and credit. Okay. So literally, when we say debit, literally all we are saying, guys, don't attach anything to it. All we are saying is the left side. So you see it literally on the left side. So when you say debit, the rent account. Let's say this is the rent account. All we're saying is the amount that we're talking about, we're going to put it on the left side. We say credit the rent account by 10,000. All we're saying is put that amount on the right side. Okay? Don't attach anything to it. Just think of debit, left, credit, right side. Okay? And that will make your life a whole lot easier. Alright? That'll make your life a whole lot easier. Alright? For those of you who have had accounting and you are like, ish, this subject, I don't understand. Chances are it's because when you thought debit, when you thought credit, you attached certain meanings to it. Instead of just thinking left side and right side, period. Okay. So we've dealt with the definition for credit. Let's look through and see are there any other key important topic matters. Okay, so if you look there on page 50, you see a whole list of examples of assets, owner's equity, so forth, so forth. Okay. The next thing that I wanted us to touch on there is cross references, which is on page 51. Now, what cross references basically just highlighting that the key thing that you need to take away is that for every debit, there is an equal and opposite credit. Okay? All right? I'm not going to go into the whole double entry thing because I want to leave that for another lecture. Okay. Just understand, for every debit, there's an equal and opposite credit. And for every credit, there's an equal and opposite debit. Okay? So you can't really speak about cross references without speaking about double entry. Okay? Wow. So this is why I'm saying you need to go and read Unit 2, particularly Unit 2, because this is literally the fundamentals of accounting. So if you can understand what's going on here, or at least just, get a good understanding of what's going on here, it'll make your life easier moving forward. When we're now saying debit this, credit this, you understand, okay, yes, we're computing the double entry, all right? You understand why, because we debited over there, we have to credit over here. We can't debit on both accounts. Okay? Right. But again, if that's flying over your head, it's the first time we've been in a, don't worry, it'll make sense when we do practical examples. That's why I'm leaving some of this stuff out. Because it's like, if I talk about it now, it'll be like, oh, guys, why did I bother coming to school with this? You know? Which is what I don't want. Okay. Right. So let's proceed with our slides. Let's proceed with our slides. Okay, so we were here. We defined and looked at all these things. We've spoken about debit, okay, and credit. All right, so in these slides, there is speaking to when an asset increases, we debit that asset account. Okay? So equipment, when you buy more equipment, we debit the equipment account. If you sell some of that equipment, we credit the equipment account. Okay? Now this stuff is again, I don't want to really step into it, but I'm just speaking on it so that you know, okay, if I need a reference point, as to when I debit, when I credit, there's a reference point. Okay? But as we go through exercises, I'm going to also go through this thing called dead click. I think some of you have heard of it. I think that's an easier way of remembering it. I didn't get it when I was actually doing accounting in high school, or in church for that matter. I just mastered the principle of, and that worked for me. But when students actually explained it to me, I was like, actually, this is easier than how I went about it. Okay? So I'm just highlighting the different ways to skin the cat. What's important is that you establish what actually works for you. Okay? Some of you maybe might just end up memorizing this, and every time you get into a test or exam, you write it down. But by the time you get to the test or exam, I hope that it's in your head. I hope you don't need to actually write this thing down. Even dead click, I hope you don't need to. But as you begin to learn it, then that's fine. You can definitely do that. All right, then this, I won't even go into it. We'll actually touch on this. It all makes sense when we go through exercises together. Okay? All right. Now, this is pretty much the last thing that I think we will touch on. Yes. That is the last thing. All right. We have two inventory systems. And I think you were getting into it. Method perpetual. Periodic, 100%. Okay? We have periodic and we have perpetual. Okay? And the unit system will actually break down this a whole lot more. But basically, when it comes to periodic and the perpetual system, it just means that we are recording our stock, our inventory, differently. Okay? If we're under the periodic inventory system, right? Routine purchases of various inventory items. How do we treat it under the periodic system? Costs debited to the purchases account. Okay. Okay, I think it's better we actually do some exercise before we actually talk about debiting and crediting. Okay, some of you may never have done that. Okay, but the whole point is that whenever we purchase inventory under the periodic, we consider it as an expense. Okay, the purchasing account is an expense account. Under the perpetual, inventory account is a asset account. Okay, so already you can see when the huge distinction. One is considered an expense, the other is considered an asset. Then when we sell inventory under the periodic, we don't make any entry into the purchases account. That inventory or stock has left us. Okay? But under the perpetual, we do actually record the fact that stock has left us, that our inventory has decreased. Okay? That asset has decreased, in other words. And then at the end of the accounting entries and related activities, okay, so in other words, at the end of the financial period, whether that period is a month or whether that's a year, end of the financial year, under the periodic inventory system, we do a stock take. All right, we go into our stores and we actually count. I'm running a grocery store. How many tomatoes do I have? How many cans of beans do I have? How many cans of sardines do I have? Okay. Whereas in the perpetual inventory system, I don't need to go do a stock take. Why? Because like in most of your grocery stores, you know, whenever you go to the till, they swipe something across the barcode. They use the barcode and they swipe it, they scan it, right? That is the perpetual inventory system taking place. By virtue of swiping that can of beans, they are recording that we have just sold a can of beans to this gentleman. So in other words, if we had 10 cans of beans before he took one can off the shelf, we now have how many? We now have 9. So there's no reason for me to walk into storage and actually do a stock take. So if I just look on the system, it should tell me. Okay. But in reality, the reality is that you are going to at some point actually just need to go and check because there is this thing called shrinkage or theft or things breaking, right? And as a result, you obviously just need to check everything. Okay. But yes, those are the main differences. The periodic, we aren't actually recording. The perpetual, we're continuously recording how much inventory we have. Okay. Every time we make a sale, we're reporting that we are our inventory has decreased. Periodic, we're like, it's chill. We'll check at the end of the period how much stock we have. Make sense? All right, awesome. All right, so those are the slides. That's the theoretical breakdown of what Learning Unit 2 is all about. That said, let me give you guys a 10-minute breather, and then when we get back, we're just going to go through a few exercises, and then I'm also going to give you homework to go and do. Okay, so I'll see you guys at 10 o'clock.